David, Henderson High Income Trust, in an article that you wrote some months ago, you talked about focusing on companies with the potential to grow their dividends. And you noted buying some stocks in the house building sector and also in mining. So I'd like to know how this investment play has worked out for you.
Well, we're dealing with the house builders first. I mean, they saw a pretty difficult Q2 in terms of share price performance because you had fears over imminent interest rate hikes. What you've seen is a strong rebound in Q3, and actually year to date the stocks we own are up. And I think when you look at the results that they've actually generated, they've actually been very strong. I mean, the likes of Galliford Try in August announced their full year results, and actually within that was an increase in their full year dividend by 40%. So that real cash flow investment theme that we're seeing is really coming through, especially with the house builders. In terms of miners, share price performance more recently has been difficult. You've seen lower commodity prices. I think fears over GDP growth in the likes of China has really put pressure on commodity prices. But I think longer term, the dynamics are still there in terms of improving operational efficiencies, selling underperforming assets and reducing capex to drive that cash flow are going to come through. And actually, in the most recent Rio Tinto results, in their interim results, you saw an improvement in their cash flow to roughly about $9 billion. And that has been driven by, again, the operational efficiencies, the lower capex, and that drove the confidence in the company to increase their dividend by 15%. So although shorter term share price weakness, I think longer term they still look good investments.
Okay, let's talk about interest rate rises. The consensus has been moving around the market as to when this will be, and a portion of the portfolio is in bonds. So I'd like to know what your thoughts are on it and whether this affects positioning.
Well, I think consensus are going for an interest rate rise either late this year or early next year. I think what's more important is the fact of the path to more normalised rates. So I think the market are starting to come around to the idea that interest rates are going to move up. But I think it's how quickly or how slowly they will move. And I think given the Bank of England won't want to jeopardise the recovery within the UK, especially at a time where interest rates are quite low, I think that path will be fairly modest and slow. And I think under that scenario, the portfolio is well positioned and should do reasonably well.
Now, the trust has had stable dividends, and recently it's been increasing them a little bit. Now, keeping in mind there's no guarantees, I'd just like to know whether this is something you foresee as continuing.
Well, firstly, any decision on the dividend is obviously done at the board level, but they do have an aspiration to grow the dividend. I think when you may have seen our third quarterly dividend was increased on an annualised rate of 2.4%, which is slightly ahead of inflation. And I think one thing I would say is that given revenue reserves have been rebuilt, given the confidence we have in the underlying growth and dividends of the holdings that we own, I think growth can continue going forward, really.
David Smith, thank you.
Thank you.